Hello all and welcome to today's session, Preparing for Recovery and Financial Sustainability. Today's session is hosted in collaboration with Mazars Ireland. We would like to warmly welcome today's panellists, Pat Magner, Audit and Business Advisory Partner, and Richard Maguire, Business Advisory and Restructuring Partner with Mazars Ireland. We greatly appreciate all the hard work and effort both Pat and Richard have provided in preparing today's presentation. We hope you enjoy this informative session. Lastly, we encourage all attendees to get interactive via the chat feature to introduce yourselves and comment throughout the session. Please also feel free to avail of the Q&A feature located at the bottom of your screens. Without further ado, I'll hand over to Pat now, who will be today's first speaker. So Pat, please take it.
So, as Cream said, my name is Pat Magner. I'm an Audit and Business Advisory Partner based in Mazars here in Limerick. And today, together with my partner Richard, I would like to have a discussion with you about preparing for recovery and financial sustainability. I really hope that this will be a discussion, and feel free to use the chat functions or the Q&A functions, and we can pick these up towards the end of the presentation. I'd like to have this discussion and share our experiences and what we feel is the best method of preparing for recovery and financial sustainability. And I think really it's incumbent on all of us as business owners to take personal responsibility to be ready for recovery. It will come. It might be slow, but it will come. I think really it's inevitable that we plan for it, and the most successful businesses usually have a plan. I'm not so sure about everybody on the call, but I know at times I have been guilty of making a plan, putting a lot of time into the plan and thinking that that's great now. Put it on a shelf and don't look at it again for a number of years. In that regard, I don't think a plan will work this time around. I think we need to be very conscious of where we are, what's coming, and being ready for it, and being able to execute a plan that delivers on what our stakeholders and shareholders require, and to make sure that we can deliver on those in a timely fashion. So I think in that sense, it's quite important that we have a look at where we're at and what's important to us. If we reflect on it, in the 8th of February this year, we had a general election. There were a lot of issues at stake at that time. Housing, Brexit, healthcare and infrastructure, as well as pensions, were all very topical at the time. These issues haven't gone away, and these issues still need to be dealt with as we move through the release from lockdown and in terms of an economic recovery. These things will have a big impact on government policy as we go forward. Only a couple of weeks after the times in February 2020, we had our first case of COVID-19 at the end of February. And after that, we all know what happened in terms of lockdown and restrictions and the devastating impact it has had. No business has been immune from it. We are aware of a couple of businesses who have exceeded, but for the vast bulk of businesses, unfortunately, it's had a very negative impact. So much so that the latest ESRI and OECD forecasts are predicting between 6 and 12% contraction in 2020. To put that in context, the general consensus was between an 8 and 9% contraction in 2009 and 10 following the financial crash. It's likely to be 2021 before we'll see a leveling off and possibly the starts of some green shoots of improvement. At the moment, we are very much I suppose what one might call an east side state, but I fear that the anaesthetic might be wearing off sooner rather than later. With government intervention and various supports, we've been quite fortunate to make sure that businesses have been able to sustain themselves for the moment. And if we have a look at some of the more recent economic data, the figures released last week by the revenue in terms of the wage subsidy scheme show that there has been a drop off in the number of claimants in receipt of the temporary wage subsidy scheme. This was a scheme introduced in March by the government to help sustain businesses. The week of the 27th of March, we saw the first recipients, which amounted to 49,000 employees. This increased greatly in the week of the 1st of May to 326,700 employees. And by last week, this number had dropped back to 232,400 employees in receipt of the wage subsidy scheme. We can also see that the number of first-time recipients had dropped off as well, which was a good sign. I suppose from here then, we need to have a look at who's been impacted. I think particularly in the Midwest, we've all been impacted. Retail, hospitality, travel tourism, manufacturing, construction, the big employers, each of them being employed are being affected by this and employment. In that regard, we can see in the slide here, the number of employers in these various sectors which are availing of the temporary wage subsidy scheme. It's quite sizable, 46%, 48%, 51%. Up to half the employers in these various sectors have been availed of the temporary wage subsidy scheme. Now, what will recovery look like? The short answer is I don't know. I'm neither a fortune teller nor an economist. Having said that, there's plenty of commentary around V-shaped recoveries, U-shaped recoveries, and most recently by the OECD, a W-shaped recovery, which takes account of the potential of a second wave. For most of us, we're involved in Indigenous-based businesses, and again, we have been the hardest hit in this sector. It just comes with the territory. The domestic businesses are those that have been affected most. I think it's important for us to take stock now of where we are in the cycle, and in Mazars we have kind of developed a forecast of how we see it. At the moment, we're quite likely to consider ourselves being in between the acute phase and the suppression phase. Quite likely the suppression phase will take a number of months to make sure that the virus has been fully suppressed and wait for vaccine. And after that, we'll look at recovery periods, which typically could take 12, 24, even 36 months. And because of that, I think we all need to ask ourselves some questions as business owners. How long will the phases last, and when could a suppression and recovery phase begin for my business? Not in general. I think we need to examine our own businesses individually. Are our businesses strong enough? Are our balance sheets strong enough? And what will the restrictions and the lifting of restrictions mean to our businesses? They quite likely will have a different impact for different businesses as we go. And how can I protect my business and be best prepared? In order to be prepared for any eventuality, it is essential that you develop a good plan. In Mazars, we have developed a plan which revolves around 6 phases. In summary, a lot of the phases are self-explanatory, but at the same time, I would like to go through them. In terms of the first steps, it's very important that businesses take time to develop a baseline of expectations of their business. I think it's incumbent upon each business owner to review their financial information from 2020, 2019, 2018, examine the trends, see what was going on in their business, what was driving sales in their business, was there concentration issues, what was driving the cost base of their business, have a look at where their business was coming from, what sectors, geographic reasons, and really get underneath the bonnet of your business and understand each number, where it comes from, how it was arrived at, and what could be the impact of it. The second part of any plan is to ensure that we look at doing an assessment. In terms of doing an assessment, I think we need to be sure that we consider all aspects of COVID-19. Now, COVID-19, the big question will be, well, how does it affect my business? And again, I think in that case, people will need to be able to do a best case, worst case analysis of their business. And in that regard, I think they may need to take some extreme views in their business. What would it look like if revenues were reduced by 75%? What does it look like if revenues are only reduced by 10%? These are quite extreme views to take on a business. It's quite important that we continue to look at that to ensure that we can get an assessment of where our business is going and what impact COVID-19 could have on it. When we look at our business and having established the parameters that could impact on our business, we need to develop a list of priorities and what's important to our business. What's important to our stakeholders, what's important to our shareholders, what's important to our suppliers, our banks. And together with the information on the previous from the previous phases of the plan in terms of our baseline and our COVID-19 impact assessment, we'll be able to action or consider actions that will help us achieve these goals. In terms of the actions, we will need to review each line of it. Okay, we now understand what our baseline is. We have an idea of the impact of the COVID-19 assessment. We understand now what's important to all our stakeholders. And in that regard, we can now look at particular actions, measure each action individually or the collective, and make sure that we can now deliver a result which will deliver upon our strategy. We need to identify what are the top line issues, who's going to deal with the sales matters, who's going to deal with the operational matters, making sure that we have continue to have our supply chain right, make sure we have enough resources available to us. Have we considered the impact of Brexit? Quite an important issue that hasn't gone away. Equally, we also need to look at what government supports are available. Will these continue? How dependent are we on government supports at the moment? What about SPCI funding? Equally, we also need to look at our working capital commitments. What have we got? What's the likely timings of it? What credit have we extended to our customers? What credit are we getting from our suppliers? What banking facilities have we? Have we a level of capital expenditure that we could maybe pare back or defer for a year or two? Make sure that we have sufficient working capital for the now and for the early phases of the commencement. It's very important that we also allocate owners to each action, because it's very important that there's somebody going to be accountable and somebody going to be responsible for the implementation of these actions. This, together with the previous steps, will then allow for financial projections to be formulated, showing the impact of all the action plans, how they impact our assessment, and whether these will then give us the results we're looking for in terms of our stakeholder requirements and desires. So just to summarize, so far we've got our baseline figures, we've done our assessment, we know the likely impact there, we've discussed with our stakeholders what's important to them and how we want to get there. We've taken various actions as well, we've measured each action, and we understand the financial consequence of it. So now we can pull together our forecast and our plan to make sure that we can now deliver on the results. The final part of this is going to be the implementation of the plan. And again, as I said earlier, it's very important that there's a bit of oversight on the implementation of the plan. Who's going to ask the tough questions? Who's going to make sure that we're holding ourselves to account? Who's going to challenge and provide that bit of oversight as we move through the various phases of recovery? These are very important questions. And it's important as business owners that maybe we use each other as sounding boards to ask some of these more challenging questions, to make sure that we are ready for recovery. As I say, the best way to be ready for recovery is to have a good plan, a strong plan, but equally a plan that will evolve and change as it needs to be ready for recovery. In that regard, I would like to probably share a story at the moment for a client of ours who approached us in early April, who was devastated that the tap has been turned off in their business. They have no income, and what were they going to do? So we began on this journey to look at it and understand their business. While we had acted for them for a number of years, we really wanted to get into the nuts and bolts of the business and understand each item, what drives their sales, again, where does it come from, who are their customers, where are their customers located, how have their customers been impacted by COVID-19, how are their customers going to deal with Brexit, all the main items. Equally looking at our supply chain, how is that of the client, how has that been impacted? Once we got a good understanding of the baseline of the business, we then started to challenge it in terms of quite extreme COVID-19 assessments, looking at real worst case scenarios. What happened, as alluded to earlier, if 75% of their revenue never recovered? What actions do they need to take then? And equally, we also started to narrow gap into a more realistic scenario with their help. We continued the process, and we're currently discussing with the shareholders what's important to them. How do they want to respond to their customer needs, their own needs as shareholders, their stakeholder needs, their banks, their suppliers, and their employees' needs. And we're currently developing what are the levels of priority to their business, what do they want to achieve out of it. We've started also to look at a number of actions around cost containment and realigning costs for a lower level of sales income. In this regard, we have provided a solution around outsourcing payroll to them. And that has allowed their admin and finance team to focus on a number of other aspects of the business. It was a neat solution for them to reduce their cost and exposure and equally provide them with a set of skills to ensure the continuity of their business. In that regard, I think the next part in terms of actioning forecasts and updating forecasts, we're still a bit away from that yet. we really need to make sure that we get the strategy right on it and the actions that will match that strategy to make sure that we continue to deliver upon it. As I spoke earlier, when you're developing your action plan, you need to be very conscious, and perhaps the fallout of the actions is that there may not be a bright outlook, but you need to consider all aspects of the plans. So in that regard, I'd like to hand over to my colleague Richard, who's going to look at a number of restructuring options in the case where they are required.
Thank you, Pat. So good afternoon, everybody. My name is Richard Maguire, and I'm a business advisory and insolvency practitioner here with Mazars in Limerick. We really are in unprecedented times, and today what I'm going to do is I'm going to give a quick review of restructuring options that may be open to companies, and I'm going to give an extra little bit of a look at the examinership process, as I feel that it's something that will be more in vogue as the economy opens up. By the time we emerge from this unprecedented challenge, we're going to have 5 or 6 months where businesses are going to have been cocooned, they're going to have had reduced trading, and they're going to be carrying holding costs and fixed costs that are building up on their balance sheet. As the economy rebounds, there's a lot of questions. Is this going to be an immediate rebound, or is it going to be a phased rebound? I think it's really going to be a phased rebound. When you look at social distancing, we're going to have a gradual recovery. So businesses can continue to incur potentially losses as they open up. We've all been adapting, we've all been working from home, and that in itself has changed the habits of our customers. So even businesses that have had cash reserves built up, they've seen them reduced. We've had forbearance from our creditors, that's likely to reduce. We've had forbearance for banks, that's also likely to reduce. And then there are businesses, as they open up, they're going to have a requirement for working capital. Some of the stock which they had may be gone out of date, so there will be a requirement in that regard. 2008 to 2016, 17, I saw a lot of liquidations, unfortunately. And I suppose the one thing that came to me during that period is that a lot of directors, shareholders, stakeholders put personal money into their business without actually having a plan. As Pat said earlier, the plan is really crucial. These funds were put in with the best of intent, but people ruled with their heart rather than their head. And I would say and encourage everybody that where we are now, we really need to discuss the impact that this COVID-19 and cocooning and reopening of economies is having on our business, and what we need to do and how we can assess that and how we can actually move forward as things improve. There will be restructuring required. Restructuring options, there are many, but I'm just going to deal with a few today. And some of it is really going to be looking at new funding and debt restructuring. We're going to look at informal and formal schemes of arrangement. Unfortunately, we're going to have to mention liquidation, and there are 2 types of liquidation, a creditors and a members. But a members voluntary liquidation could actually be a way of getting value to shareholders in a very tax efficient manner. That's something that I think that could be important, particularly if businesses may not open. And then we're going to look at the examinership process. When we look at the new funding and the debt restructure, a number of weeks ago, we had Damien Garrahy from AIB Bank talk to us in relation to AIB and their finances and the loans and the supports that they had available. One thing that did come out, and I think when people are looking at opportunities or their options really, they really need to look at who their existing bank is, because they are the ones who are most likely to work with them. It is most likely that you will not have a new banking provider that will be anxious to take you on at this uncertain time. All of the pillar banks work with SBCI, and they all have a working capital loan. These loans are low interest, they're unsecured loans up to €500,000, and they offer flexible repayments. This is something which there are criteria to be met, but it is something that is available to businesses. Many businesses would have had cash reserves, but over the past number of months and maybe years, they have depleted reserves. And maybe an option for these, particularly now, might be invoice financing. And this is a way of invoicing your debtors and receiving cash for that within 24 hours. The funding can be a one-off funding of an invoice if it's a large invoice that may not be paid for, but it's a blue chip company. It may be on a single debtor. You may have a contract with a particular company, but they take 60 days and your business needs quicker cash flow than that. Or it may be for the whole ledger book, where finance houses will provide up to maybe 70% financing on your debtor's ledger and you're receiving the funding on that. It's actually a really good discipline also, because it makes sure that you collect your debtors and follow up with your debtors on a very regular basis. Some people may have requirement to produce something for a customer, but that involves buying a piece of equipment or buying something as a raw material that they don't have the cash flow for. There are funding options out there to get supplier funding, whereby if you have a completed contract, you can actually get funding so that you can pay the supplier and have the product in stock and to be able to on-sell it to your customer that you have the contract with. As we look at restructuring, you have to look at private equity, and some businesses are suitable for long-term investment and business angels, and that's where the business plan will show this, so that there can be a return for these investors. And it may be something that may not be suitable for banking, but there may be an opportunity there to seek external investment. One thing to also bear in mind is that the Employment Investment Incentive, the EII as is more commonly known, that offers an opportunity for individuals to invest in companies and get tax relief at 40% on their investment. And that may well be relevant also for the directors of the company if they wish to put funds back in. And all of this is obviously predicated on their plan being done and they realizing that this company to succeed needs this investment. Sale of the business. Some people may look and they may feel that really they're at an age and stage that they're not going to reopen or don't want to reopen. It may be something that they may consider is the sale of the business. I will say that in the current environment, it is likely to be very difficult in the short and the medium term. Another form of restructure, when we look at our balance sheet and when we look at where we are as a company, can be informal and formal schemes of arrangement. The informal scheme of arrangement, that's a voluntary arrangement, and it's arranged to compromise your creditors. There's no court approval involved, there's no court involvement at all in it, and it really involves sitting down with your creditors in a room and outlining the financial position of the company to them and telling them the alternatives. And oftentimes, if a compromise can't be reached with these creditors, the alternative is a liquidation. This informal scheme is really ideal where you have a small number of creditors. It can be a bit difficult to get a large number of creditors to accept and to agree to a scheme like this. It's not required that everybody compromises. However, your plan will more than likely be looking at everybody compromising, and if they don't, it can put your plan on an unviable footing. So really, informal scheme is for smaller numbers where you feel you can get all the creditors to come together. A formal scheme of arrangement then is different. That is really dealing with your creditors on a formal basis with court oversight. There is a high threshold in this. You do need to receive the agreement of 75% of your creditors in number and in value to agree to a proposal to a write-down. Now, the advantage of the formal scheme is that you can actually pick one class of creditor and you can reach agreement with them and write them down and not affect other creditors. This has been used in the airline industry recently, particularly with their bondholders being their largest creditor, where they're seeking to reach agreement with those class of creditor while leaving the other creditors untouched. Indeed, we've all probably read locally that Nordic Aviation have entered the formal scheme of arrangement, but obviously they're a large corporate. It's not just for the large corporates of the Nordic Aviation size. Obviously, not every company is going to be able to restructure. There are going to be challenges for companies, and companies are going to face liquidation. If a business or directors or shareholders realize that it is not viable for the company to continue, then it's important that the directors realize that at an early stage. The directors have a responsibility, and it's important to record the minutes of the decisions that they're taking, minutes of meetings of the affairs of the company, minutes of meetings with suppliers, minutes of meetings with banks, so that if the company does go into liquidation, that it can be shown that these directors have acted honestly and responsibly in their duties as directors. But maybe enough of the doom and gloom for the moment. There are members' voluntary liquidations, and there are businesses out there who have reserves built up. And for one reason or another, whether it's age and stage or whether it's the business that they're in, that it is unlikely to recover, and they may be not going to reopen the business. These businesses and shareholders will want to know, how do they get their value out to the shareholders? Members' voluntary liquidation is a very easy and tax efficient way of doing that. There are reliefs available in certain cases, like retirement relief and entrepreneurial relief, which can result in individuals receiving their funds out with very little tax. Also, as a method of extracting cash, apart from the cash, it's actually very cost effective in terms of the procedures that are involved with that. So as I move on to examinership, and what is examinership? And it's a restructuring option which in the mid-90s and early 90s was introduced by government to preserve the Larry Goodman Group. And the process is governed by the Companies Acts, and it allows vulnerable but viable companies to restructure their liabilities and to return to profitability. That profitability, I suppose, is realized by compromising the creditors and also new investments coming into the company. Now the company is stable, employees' jobs are preserved, creditors are now back doing business with the company. Now, the examinership process in itself is a 70-day process. It's quite short. There is an option to have it extended by further 30 days to 100 days with the approval of the court. But again, to get all creditors together, to work out the investment that's going to be required, it is all done in 70 days, which is really only 10 weeks, or 100 days, 14 weeks. It is a difficult and a challenging ask, particularly in light where people are working from home at the moment, and meetings of creditors can be difficult. However, there are requirements for a successful application to the court, and that falls into two categories. There's the category on the right-hand side of the screen there, where we have 1 to 4, which is really in relation to the petition to put the company into examinership. And then the following 3 is while the examiner is in occupation as examiner and getting a scheme of arrangement agreed with creditors. I suppose, just to go through that, the company needs to be insolvent. It needs to be able to demonstrate that it's unable to pay its debts. And it doesn't have to be just on a cash flow basis, it can also be on a balance sheet basis. The future viability of the business is key. This examinership is only appropriate for viable businesses where it can be established that they will be viable going forward, that they have a strong trading business, and that if the legacy debt that was there was taken away, that this company can trade successfully and profitably. It's very suitable for retail, and we'll take another look at that very shortly. Cash flows will need to be shown to the court both during the examinership period and post-examinership. In the examinership period, it's key that the company can demonstrate that it has enough cash flow to actually be in a position to pay its liabilities as they fall due during the 100, up to 100 days. There can be challenges with that because some suppliers who know that they're going to be losing out as part of this process may actually feel that they want to be paid cash on delivery. So that's obviously going to put an extra draw on you. As I said, the left-hand side of the circle deals with when the examiner is appointed. And at day 35 of the process, the examiner is obliged to go back to court and advise the court as to how matters are progressing. And do they believe that they can get the support of the creditors and that an investment can be sought. In the final scheme of arrangement, it needs to be apparent that the scheme is equitable to all creditors. That doesn't mean that all creditors get the exact same dividend or get the exact same payment, but it does need to be equitable, and it does need to show that the creditors will actually be better off than they would be should the company go into liquidation. Finally, the scheme of arrangement will need to show that there's an investment required, or need to show the investment which is required. And the investment will be used for 3 phases. First one will be the amount to pay the creditors the dividend under the scheme of arrangement. The second one will be to cover the costs of the examinership. And thirdly, it will be to provide the company with enough working capital that it can demonstrate that it can be viable going forward. So I've mentioned a few things that examinership can address. But, just to get a bit more detail, for some reasons, perhaps as a result of COVID-19 and losses being built up and resulting in the company having liabilities on its balance sheet, perhaps because of mismanagement, the company finds itself with legacy creditors. And despite the future profitable trading, it is very unlikely to be able to discharge those. This is something that an examinership can address. As regards bank debt, in an examinership, you cannot force down or force the bank to take a write down and then force the bank to work with the company going forward. The bank debt can be reduced, but it can only be reduced to the amount of security held by, or the amount of security value. So therefore, that's relatively easy when it comes to property. But in terms of cash flows, that can be a challenge to determine what the value is. As part of this process, though, it can be possible to write down some of the debt of the bank and then refinance with maybe an alternative lender or with the external investment or the internal investment if it's coming from internal shareholders coming into the company. I mentioned retail there a few minutes ago. With the retail sector, many businesses are going to suffer from a lack of footfall and the fact that we've all got used to buying now online. And at the time these retail businesses set up, they entered leases, which at the time they felt that they could pay, but now those leases are onerous. And they really can use this as an opportunity to, I suppose, renegotiate those leases. And if they can't renegotiate, there is an option to repudiate the leases in their entirety and hand back the keys of the property. Many companies, construction sector, may have claims against them. These are contingent liabilities. There can also be litigation pending against companies, or there can be insurance claims. These can be significant for a company, and as such, these can be addressed in the process, and these liabilities can be crammed down. Some companies have entered into contracts with their customers which are no longer sustainable. They may have agreed to supply a customer with a particular product at a particular price, but now as a result of COVID, or the costs of the supplies are getting more expensive, and they may want to get out of these onerous contracts. Examinership offers you that opportunity. Now, as I said, the time period is up to 100 days. It's a very short period. It could be difficult in the current environment to secure investment. We don't probably have enough of a track record at the moment to see how viable the company can be going forward, particularly in retail. So it may be something that has to be left for a little while, but it is something that really works to agree a compromise with your creditors in the right circumstances. As part of the process, there may be essential creditors that we need to talk about. There may be creditors that are the only ones, or suppliers, they're the only ones who can actually supply you with a particular product. If they're the only supplier that can supply you with a product, they may be essential to the viability of the business going forward. And therefore, as part of the process, they may not be trammed down. They may actually be one of the essential creditors, which is approved by the court to be paid potentially in full. When we look at new investment, I suppose it's important to consider that this investment could be external as well as internal. It also could be, as I said, invoice discounting or supplier discounting. I'm not overly concerned if it's going to be internal investment, but the examiner does have an obligation to seek expressions of interest from external parties in relation to the investment. That external third party could, putting an offer forward, could result in the shareholders and the management of the company losing control. And it's important that when we're considering examinership, that the relevant stakeholders are aware that should an investor come in who is prepared to offer more to creditors or is in a position to offer more to creditors, that the shareholders, the incumbents, may actually lose control. Another thing, and finally to consider, is the cost of the examinership. It can be a very high cost, particularly as it's a high court procedure. There are procedures to have it in the circuit court for smaller companies, and with that, it does have an opportunity to reduce the costs. So, just maybe to say what the role of the examiner is in the creditor or in the examinership, it's basically it's an overseer. It's a non-executive role. The directors still remain their full authority to run the company, but the directors and the examiner would generally do this in a close consultation. The sole priority in examinership really is to agree the scheme of arrangement, restructure the business, and return it as a profitable entity. So the issues, though, for various classes of creditors, when a company faces examinership, from a creditor's point of view, there are various classes, and I've just listed a few here. The fixed charge creditor, generally your banks, as I said earlier, they cannot be reduced. But if the examinership isn't successful, so for example, we can't get an investor, we don't get agreement with our creditors, or that the company just isn't viable during the examinership period, the costs of the examinership, which are the examiner's costs and the examiner's legal costs, are borne first before the fixed charge. As regards preferential creditors, this is predominantly the revenue. It's very important to try and have revenue on your side and have support with revenue, but revenue will always fight their corner in terms of what they're looking for in terms of return on their debt. Floating charge again is predominantly the bank, which I've just spoken about. But at the start of an examinership period, you could have debtors and stock in a company to the value of €1 million. But during the process, if the company hasn't traded well and the examinership fails, that value could have been eroded. If that value is eroded, it leaves less for the floating charge holders. And obviously, again, in that case, the examiner's costs and the examiner's legal costs are paid before the floating charge holders. The unsecured creditors, unfortunately, are the ones who probably take it the worst. They are your normal suppliers who supply to the business, and in many cases, they receive anywhere from 2 to 5 cents per euro of what they were due. So they are really suffering in these scenarios. There is a bit of light for them if they have retention of title and if there is stock held by the company at the start of the examinership process. In that case, they can get their cost of their goods is recognized as an expense of the examinership, and they should be paid on that. I previously mentioned, obviously, the contingent liabilities for you. So my final slide here is really in relation to the issues which are relevant to trading in examinership. If somebody is considering this, they need to consider that their suppliers may insist on cash on delivery during the 70 to 100 day period. Debtors may use it as an opportunity to not actually pay their debt as they would normally have. Because if the examinership fails and the company goes into liquidation, they may fight with a liquidator in terms of what they actually owe. Some companies that go into examinership may find that their bookings or their contracts fall off. And the reason behind that is that customers, take a hotel for example, customers may be unwilling to pay a deposit because they may not be sure that the hotel is going to be in existence when they actually go to take their break or their holiday. Also, you can find that some business relationships suffer. Suppliers, unsecured creditors, as I said, getting 2 to 5 cents, may decide that they no longer wish to deal with this company, and therefore you may need to source supplies from an alternative. Obviously, everybody is concerned about the employees because this can be a very uncertain time for employees, and a lot of reassurance will be required for them in the process, and they will need to be kept appraised of the situation. Obviously, in this scenario where a business is advertised, people advertise for sale and investment sought, there's PR attaching to it, and that can be negative, but it's not something that over the past 10 years that I would have seen as something that's very, very material. I mean, we've all bought goods in Elvery's and B&Q, and we've all flown with CityJet, and all of those have been through examinership, and it's not something that we have actually placed any issue with in terms of returning and buying and shopping with those businesses. So that's it from me. It's really been a run around restructuring options. I will say that every business is different. I will also say that the piece of advice that I would have for people is that please plan for what is ahead. Please don't put business money into a business without having a plan, and use this time now as the opportunity to restructure and put yourself on a solid foundation going forward. There may be some questions there, but before I do, I'd just like to thank Cuiva in the Limerick Chamber for formulating today, and I'd also like to wish everybody who's on here the very best with their business in these challenging times. It is difficult, and I suppose we're all in this together. If there is anything that Pat or I can do for you, please don't hesitate to contact us in that regard. Now, just in terms of questions, I am just looking here to see if I can see something.
There's a question there, Richard, in connection with likely support for examinership.
Is that likely support from the financial institutions?
Yeah. Sorry. Yeah.
Okay. I suppose financial institutions can often take a differing view, and it will really depend on the relationship that the customer has with the financial institution. Some financial institutions, if they feel that they are not going to do well out of the process, or that the company will not emerge, they can decide to essentially appoint a receiver before the examinership process starts, and then they will, so they may not support. But if the bank are feeling that this company is viable and can be come out of it and will return to profitability, they can be very supportive of the situation. So it really is on a case-by-case basis.
There's one further question there. It's on the same team, but it's what his revenues view.
What his revenues view? Revenue find it very challenging, and they're not allowed to compromise with creditors in a normal scenario. So therefore, the formal scheme of arrangement and the examinership actually gives them the option to compromise the debt. They are, when it comes to an examinership, they become, obviously, as I said, they fight their corner, but they become pragmatic on it, and that there is only so much, and they will realize that they will probably be better off in this scenario than they would be if the company goes into liquidation. And that's where I said that that all creditors need to be treated equitably. Revenue will be paid more than the unsecured creditors in the vast majority of cases. And that's just the way it works because of their ranking. Okay. I think from my point, I'd like to again reiterate to thank the Chamber and thank Quiva for their facilitating us today, and again to wish everybody well. Thank you.
Thanks very much.